Today we're going to talk about the difference between FHA loans and conventional loans and what it means for you as a home buyer. And we're getting started right now. Hey, what's going on? I'm Emmett Dempsey, mortgage advisor with Geneva Financial here in beautiful Port St Lucie, Florida, and welcome to another mortgage and home buying tip. If this is your first time here and you want to learn more about mortgages or the home buying process in general, go ahead and subscribe to my channel and ring that bell so you don't miss anything. Okay, FHA loans versus conventional loans. It's definitely a question I get asked every day. Those are some of the most frequent loans that we do here just in this country. So which loan is right for you? So the answer to that question, like a lot of the questions that I get asked, is it depends. Depends on your personal goals. So there's no one size fits all for everything. That's why it's important to have a mortgage planning meeting with me to know exactly what your goals are, to see what's best for you. FHA and conventional, they each have pluses and minuses. I'm going to go over them right now. Let's go ahead and start with the FHA loan. First, the good parts about the FHA loan. They allow lower FICO scores, some as low as 500. Most lenders will go down to 580. I know we do 580 is our minimum FICO, but some will go below that with 10% down. Low down payment, only about 3.5% down that you have to pay. FHA requires that you make a 3.5% down payment. So if you're buying a house, you can have your buyer's agent ask the seller for some seller concessions, help pay your closing costs, and all you're paying is your 3.5% down payment. That's what I always recommend. They allow higher debt-to-income limits. Basically, debt-to-income is a percentage of your gross income. Roughly, usually the maximum is 50% of your gross income. So if you make $10,000 a month, the maximum for your new mortgage payment, HOA, all your debts can be is $5,000. So it's basically divided by 2. Whereas FHA will allow you to go over that 50% limit. I've done some FHA loans as high as 52, 55 with compensating factors, and I got an approval. So FHA is the only one that allows that besides VA. Also lower rates. FHA loans are insured by the Housing and Urban Development. They're insured by the government. So since they're insured against default, of course the lenders will allow a lower interest rate. Basically, it's an exchange of risk based on you as a taxpayer, but it's spread all over all the taxpayers. So therefore, interest rate FHA loans are lower for that. Okay, so some of the bad things about FHA. First, it's got a funding fee, 1.75% of the purchase price, and you can finance that. Most of them do, but it's 1.75%. So there's a base loan and then there's a gross loan. That gross loan is 1.75% that gets added on top. So that it's that funding fee. That's your total loan amount. Also, mortgage insurance. It's 0.85% of the loan amount, and that's on there forever, no matter what your loan to value is. So even if you make a large payment, even right after closing, you still have that mortgage insurance on that loan for the life of the loan. So a lot of folks don't know that. It's kind of going back and forth. Unless you're putting down I take that back. If you're putting down at least, I believe it's 5%, it comes off in 11 years. But generally, even 11 years is a long time that most people will stay in a house. But that mortgage insurance is not loan to value dependent. It depends on how much you put down. Also, the property requirements. FHA has certain property requirements. It's not as extensive as some people think. It's really just a head and shoulders inspection inside the attic, but it can't be a fixer-upper. So unless you can go a different FHA loan, it's an FHA 2 or 3K, but go ahead and do your research on that. On that loan as well. That 2 or 3K is a renovation loan if you do want to buy a fixer-upper. But buying a standard standalone house, it has some property requirements that need to be fixed before closing. Okay, so let's talk about the conventional loan. Conventional loans are what Fannie Mae, Freddie Mac. You might have heard those terms. Those are the two government-sponsored entities who buy these mortgages. Conventional loans are not generally insured by the government, so their rates are higher. So that's definitely a negative. They're very credit sensitive, so you got to have much better credit on a conventional loan than doing an FHA loan. So it's got a 620 minimum, so you have to have a 620. And you can do as little as 3% down on conventional. You don't need 20% down. So that's kind of a good thing. 3% down if you're a first-time home buyer, unless you go the Fannie Mae Home Ready loan or Freddie Mac Home Possible. Give me a call if you want. You can talk about those in further detail. They're definitely great loan programs. The debt to income on a conventional, that's generally a 50% hard max. And then even going above 45, you got to have some compensating factors like some assets after closing. We call it reserves. So the debt to income is very sensitive. So conventional loans, you generally have pretty good credit history with some assets possibly after closing, and then to do all that. So, but a good thing is that the property requirements, that if you do want to buy a house that's maybe not perfect, buying with a conventional loan is definitely good. You might see some listings with cash or conventional, because conventional financing appraisals are not as stringent as an FHA appraisal is. Now, one big thing I want to say to the end is student loans. There's over $1 trillion in this country in student loans. FHA and conventional loans handle things differently on student loans. Whereas an FHA, say if you have $20,000 in student loans, and then your payment is income based. Say it's even zero on your credit report, or if it's $100, I have to use a 1% payment. And so on a $20,000 student loan, I got to use $200 no matter what. For some people, it can help them fall out of qualification, because I have to use the 1% figure no matter what. If you're in an income-based repayment, if you're deferred, I have to add a 1% payment anyway. But if you're income-based repayment plan, then I have to use 1% no matter what. Conventional loans, however, if your payment says zero in your income-based repayment plan, I can use zero. So that helps people qualify. So that's one good thing about conventional, that they've changed their guidelines on student loans, as opposed to FHA loans. So as always, which one you go with, it depends on your personal situation. So give me a call. Go to dempseymortgage.com for your free rate quote and mortgage planning session. I'll go over the FHA versus conventional on a mortgage coach. And I'll go ahead and provide a mortgage coach TCA in the show notes down below. So go ahead and check that out. Thank you. As always, if you want to learn more about mortgages or the home buying process in general, go and subscribe to my channel, ring that bell so you don't miss anything. Thank you so much for watching, and I'll see you on the next one.